first off, I want to thank Multifamily Northwest for allowing me here to speak today. I work for Sabal Capital Partners and primarily a small balance space for Fannie and Freddie loans, meaning $1 to about $7.5 million in proceeds. Again, me and my partner here sitting in this room, our team produces probably anywhere from probably $60 to $100 million in transaction volume. Average loan size is about 2.3 million. So it kind of gives you an indication of how many units we see, probably about 40 to 50 deals per year that we get through the pipeline. With that, right, again, Portland native. I live in Tigard, Oregon. Graduated Oregon State in 2007. Go Beavs. I don't know if we have any Beavers in the room here. Also, that does make me a millennial. Don't hate me for that. I don't know if there's cheers or boos in the room because of that. So I have been through a recycle similar to this, kind of started my career in 2007 with a recessionary cycle. I know we're not officially in a recession yet, but very much has the makings of what's going on. So because of that, right, I am a millennial. I'm on Facebook, I'm on LinkedIn, Instagram, TikTok. Not sure if anyone TikToks in the room here. Okay, all right. Got some people out there. The reason I bring this up is, again, we keep saying soft landing, and this is feeling more like a plane crash. And it's not me that's going to say this, but I'm going to showcase a TikTok video today. So I want to apologize on the forefront of this because there's an expletive halfway through this, but I think it's kind of an appropriate summation of what's going on with the Fed right now. So I'm going to let this gentleman, Robert Ross, he's an influencer with TikTok, with TikStocks, take it over from here.
Let me get something straight here. The Federal Reserve said in 2021 that they won't raise interest rates until 2024, yet they've raised interest rates at the fastest rate in 40 years. And then they said inflation is transitory and will be back to 2% by 2022. Yet we have the highest inflation since the 1970s, but it gets worse. They also said as recently as 3 months ago that a recession isn't likely, but are now saying a recession is likely. Look, I know people get stuff wrong in this business all the time, but when you have 400 PhD economists at your disposal and you still miss on every major forecast, something tells you that your current forecasts don't mean shit either, and you're on your way to making a major policy mistake and probably pushing the U.S. into a severe recession. Like, what the f***?
So, you're welcome for that. So, you guys are paying a lot of money for this. Thought I'd give you some entertainment. It's kind of talking about this, right? Because interest rates is kind of the subject of conversation, and the interest rates have been basically being pushed up by the federal funds rate. So this is kind of looking at the historical federal funds rate, for the last, I think this is for the last 10 years. So obviously in 2010 we had a previous recession. QE kind of kicked things into gear. They had to stimulate the economy. They kept the federal funds rate pretty much at 0%. Uptick in the economy, saw that kind of go up in 2016 till 2019, 2020. COVID hit again, boom, blows up the economy, and we have QE again. So again, keeping that Fed rate low until just recently here. So rate hikes, I kind of want to touch on these real quick. So this is the fastest the Fed has hiked the rates in our modern history. Again, 25 basis points in March, 50 basis points in May. Again, three cycles of 75 basis point increases over the last three Fed meetings. Inflationary data came out on Thursday last week, still above 8%, which I think that's where the Fed's trying to get under. Again, it's lagging indications, but kind of giving us an indication that they're going to hike them another 75 basis points on November 2nd. We are currently, I think, at a 3 to 3.25, kind of with the federal funds rate, so that's kind of pushing everything up from there. So what does that do? So again, Patrick alluded to it before. So this basically impacts our treasury curve yield for the rates for everything. So this is tracking the 5, the 7, and the 10-year rate from 2010 until recently here. Obviously, you see that pretty big hike. And so as you see, 2020 to 2022, the treasury rates through QE were incredibly low. I think there was a cycle there in 2020, they were down I think 50 basis points for a short stint. What that means as far as like the interest rate market for a lot of coupon lenders, and I know with Freddie and Fannie and agency financing, is we're a spread over that treasury rate. Anything I would say to 150 to 200 basis points over that treasury rate. And so, again, that depends on mitigants, leverage, debt coverage ratio for the loans. But for the longest time, I mean, we were doing rates for 3%, 3.5%. There was a lot of transactions happening. If you had the ability to refinance or buy a building at a 3% rate, it helped you get leverage. There was a lot of deals happening. I think even in 2020, Freddie and Fannie both implemented floors with the Treasury at 90 basis points because rates were starting to get in like the sub 2.5 range and they're getting really scared. So anyhow, what does that mean? So this is the historic volume of both refinances and acquisitions here in the Portland metro market. And then we're also pulled for Greater Oregon, but kind of gives you an indication of what's going on out there in the market. And this is 2010. You obviously see an uptick till 2000, I'd say 21 for the Portland market. And then refinance activity is kind of a really big telling sign there, right? It's kind of skyrocketed. On average, it's 50 refinances in a given year, and from 2017 to 2029. And mind you, that's also during COVID when everything kind of shut down for a stint. 85 refinances, and then again 45 transactions here in the Portland metro area. Again, this is for Greater Oregon. What you're looking at is, this is all pulled from Real Capital Analytics, 5+ units, $1 million loans or more, whatnot. This isn't pulling all the transactions. Again, there's deals that we're saying seller financing or all cash offers and whatnot and letter refinanced. However, this is all the data that was basically Real Capital Analytics. Any deal that was financed with some sort of financing out there from a bank, credit union, agency, CMBS loan, whatnot. So again, you look at the data, this is for Greater Oregon, you're going to see an uptick in refinance activity in 2021. Rates were fantastic. Again, quarters 1, 2 were pretty good this year as well, so you're going to see that. Here's the real telling sign, is what we're kind of going to get into here, is the third quarter of this year, 2022. So this is basically pulling for the last 36 months of activity out there in the market. Here's the number of units that were basically sold, the sale proceeds, refinances, and in a given quarter, we're probably looking in the Portland metro area, about 20 on average, probably refinances in a given year. In quarter 3 of 2022, there were 3 refinances. Kind of telling you, right? If interest rates start to tick up, people aren't going to be moving so much. Greater Oregon, same thing, all right? Here's the sales transaction volume. You start to see it kind of downtrend a bit, but real telling there is refinances, right? There's 8 refinances in quarter 3, and so far in quarter 4, again, this is kind of lagging data again, but 0 refinances in quarter 4. This is Fannie and Freddie volumes, again, they have volume caps set by the FHFA, which is Federal Home Loan Finance Agency, and they give volume caps every year. There's 2 caps that they give, basically a dollar volume that they're allowed to do, which I think this year is about $70 billion, and then also they have workforce housing goals, affordable housing goals that they have to hit. Well, real telling for this year, I mean, Fannie just released their data on Friday last week, so I was able to pull it, but they're pretty much in line with where they wanted to be for the year. However, they've given guidance that they're probably not going to hit their goals for the caps because they expect the last 3 quarters to kind of down slump. Same thing with Freddie. They haven't released their September data yet, but again, you can kind of see both Freddie and Fannie Mae do a lot of their volume in quarter 4 of every given year, and they expect that volume to drop off significantly. So again, kind of a telling sign of the times. So what this means, and again, I thought this was probably a good situation to put together. This is a deal that we did earlier this year. Again, I don't want you to pay attention to the underwriting of this, right? It's a bunch of numbers, it's jargon, whatnot. But again, pay attention to kind of the fundamentals, the loan proceeds and the leverage. This was done at a 3.6% rate, I think, as a 10-year term. So just seeing an uptick in what we're seeing with interest rates, taking that same transaction and applying the same fundamentals with an increase in interest rate, what happens, right? At a 4% interest rate, I don't know if you could all see this, but it drops down to just a 71% leverage. At a 5% interest rate, we're dropping down to a 64% leverage. So again, kind of telling of what we're kind of seeing today. And then at a 6% rate, again, that same transaction with the same purchase price drops down to a 57% leverage. So I'm not trying to scare anybody in the room, but this is just what, as lenders, this is what we're seeing, and I'm sure if you're coming in and kind of kicking the tires with us, this is kind of what you're hearing from your lending sources out there, as leverage is dropping. So I thought this was a funny meme. Thought I'd throw it in there, so I apologize again. So what's this mean, right? What is the new normal? Well, I think the Fed is overcorrecting. I think they were lagging when what they should have done stuff earlier. Now they're coming in with this fire sale and really jacking up the rates and it's really messing up the markets. The only activity going forward is going to be basically out of necessity, right? That's going to be any deals that are coming up for maturity, construction takeout loans, bridge deals. You might have some, cash in refinances, some deals with capital calls. Obviously we've already started to see this. There's going to be a sharp slowdown in refinance activity, and I expect, I think the sales transaction activity is kind of a lagging indicator. I think deals right now are on 1031 exchanges. They're gone hard on the money, and I think they need to execute those. But I think after we see the execution of all those deals close, it's probably going to slow down until we kind of get some stability in the market. So again, lower leverage deals will continue to trade, or all cash deals. Higher leverage deals, like she mentioned, cash-in deals, they're going to have capital calls. And there's going to be either two things, right? They're going to have enough equity to come in and basically come in with that cash neutral, or they're going to have to sell the property, and I think there's going to be opportunity with those deals. I think interest rates, again, will peak by the end of this year just with the federal funds. They're shooting for what they've said is about a 4% federal funds rate, maybe even a 5% federal funds rate, I think is the guidance now. So that's obviously going to uptick rates. If we go into a recession, they're going to have to cut those rates to spur activity again. So that'll probably happen, I imagine, probably second quarter of next year. We're going to be fully in a recession. Forecast, and again, I'm not trying to be bleak here, but there is a storm brewing. And how do you guys prepare for this, right? The biggest thing I tell all my borrowers out there, the people we work with, is again, know your loan documentation. And so if you did have an opportunity to lock in those rates when they're at a 3.5% range, these agency side, and you have to take a look and work with your lender, but these are assumable. There's an opportunity for someone to come in and buy your property at a very low interest rate, especially if you levered it up, and get a pretty good deal on it. So that's something to keep in mind. Also, some of these agency loans, again, and I know you guys work with, there's other lending institutions out there, but you could put secondary liens on them. Again, know your loan documents and what they allow. Know your prepayment schedule. Big thing right now, again, silver lining here, is with interest rates going up, is yield maintenance, prepayment penalties drop across the board. Again, that's just kind of a little detail that's just minute, but if you have an opportunity and it comes up, if it's a nice step down prepayment or no prepayment penalty, you have the opportunity to get out. I think going forward, soft prepayments or adjustable rate loans are kind of key. I think lenders are probably going to tighten their underwriting guidance because they're looking for better deals, and you're going to see lower leverage deals. But that's kind of the guidance going forward here. Again, it's not great, but it's what we're seeing here in the market. Here are the lending sources out there. Again, I work on the agency side. So normal, 30 to 35-year amortizations is still pretty typical. I know Fannie right now is offering 35-year amortizations on some deals, which is great on a tier 2 basis. 120 to 125 debt coverage ratio. Banks and credit unions, again, I know are still active there in lending. Everyone I talk to, though, is about, I would say, 55 to 60, maybe 65% leverage, just kind of given what we're seeing in the market right now based upon debt coverage and interest rates going up. I do know a lot of banking institutions right now are starting to collect deposits. So if you're doing a loan with them or looking to do a loan with them, they're going to look for some sort of deposit, maybe 10% of the loan amount. Life companies, I know, are some of them are still doing business out there. The CMBS market is blown up completely. I know it's about a 300 basis point spread over it, so there's no one really buying the paper. But again, there's deal to be had on lower leverage. Again, if you want to lock them, I know on the agency side, we could lock stuff with the SERLs, Freddie Mac on the small balance, they lock at application. A lot of banks and institutions will lock the spread for about 60 days. So giving the opportunity right now, depending if you want to lock in the rate up front, they'll do so. Sabal pays me, so I have to kind of highlight some of our deals. I apologize real quick. These are some that I've done before. Not trying to rub salt in the wound, but 3.6% rate on a 75% leverage deal earlier this year. This is another one we did with full term IO on a 10-year term basis. Again, this was 3.53 earlier this year. One that we locked earlier this year and are currently in closing with right now. So if you've seen the rate go up 4.79. I'm really going to rub salt in the wound with this one. This is one we did 2.78% in July of 21. I think this was a 5-year term at a 1% rate. So again, 75% leverage on this deal. Again, kind of different times. But this is my contact, and again, thank you guys for your time and consideration today.